Hey guys, Toby Mathis here, and today we're going to talk about the IRS and their two tax systems. In fact, do you even know which one you're in? And I'm going to give you a little explanation here. Wages, top bracket, federal, 37% plus 15.3%. For the employment taxes, capital gains is 0 to 20%, and borrowed money is a whopping 20%. Same IRS, same tax code, three completely different outcomes, and every one of them is 100% legal. So why does one person pay 37% on every dollar they earn plus employment taxes, while someone else pays 0? It's not because one person is cheating. It's not because the system is broken. It's because they are effectively two tax systems operating inside the United States tax code right now, simultaneously. One of them applies to you automatically. You don't sign up for it, you don't choose it, you're just in it from your very first paycheck. The other one, you have to choose to enter. And most Americans never do because they can't, but because, well, nobody even told them that it existed. So today I'm going to show you both systems, exactly how they work, and most importantly, which one you're currently in. So let's start with the system most Americans live in their entire lives, and that's the W-2 system. The default, that's you're an employee. Here's how it works. You get a job, your employer puts you on their payroll, and before you even see a single dollar, before the money ever hits your bank account, the government has already taken its cut. Federal income tax, withheld. Social Security, Medicare, withheld automatically every single paycheck. Now let me make this concrete because I want you to feel this, not just understand it intellectually. Imagine somebody is working at McDonald's. I started working at McDonald's. It was $4.15 an hour, right? You're working at McDonald's, you're entry level. Now it's more like 15 bucks an hour, 20 bucks an hour. Maybe they're young, maybe they're just getting started. Maybe this is their only income and they earn their wages. And here's what happens to those wages before they see them. They get withheld. They pay federal income taxes. They pay state income tax. Depending on what state they're in, they pay Social Security tax, which is 6.2% straight off the top. They pay Medicare tax, which is another 1.45. And if you're wondering why I put 15.3, it's because the employer pays the other half. And here's the part most people don't realize. Like when the employer is actually matching that 6.2 and 1.5, that's actually the true cost of that tax. And that's the cost on a McDonald's worker's labor. You add both sides up together, and it's significantly higher than what shows even up on your pay stub. That person, that employee, me, when I first started McDonald's, I didn't opt into that system. I didn't make a strategic mistake. You just got a job and now you're in that system automatically. And the system automatically positions you to pay the highest rates available on every single dollar that you earn. And that's system one. And the critical thing to understand is this: you're in it by default. There is no decision that you made. Now I want you to picture something. You just landed at Orlando International Airport. You're headed to Disney World. You follow the signs because that's what you do. You follow the signs to Disney World. And you get on a highway and then you start paying tolls. I remember throwing quarters into what looked like a urinal on the side of the road. Now they just take a snapshot of your license plate. But the result is the same. You pay tolls the whole way to Disney. And here's what nobody tells you at the airport. There's another road. It's the first exit out of that airport. It's Sand Lake Road. It has a number for it now. But it runs parallel. No signs pointing to it, no announcements, but it's a public road and it's completely legal and it's free. And it gets you to Disney just the same without paying a single toll. Most people never take it, not because they're blocked, but because nobody ever told them that it's there. Nobody ever handed them a map. Now you can go to Google Maps and you can say avoid tolls and it'll find the way. But the US tax code works exactly the same way. Tax system 2 isn't a secret. It's not a loophole. It's not something hidden in a back room for billionaires. It's written directly into the Internal Revenue Code. the same document that governs every taxpayer in America. It's just that to access it, you have to know it's there, and you have to make a choice to enter it. So what does that road actually look like? The moment you operate a business or your own income-producing assets, a completely different set of rules begins to apply. And let me walk you through the big ones. I'm going to kind of go over, I think there's about 6 points really here. Number one, and this is huge. If you get nothing out of this video, let this stick in. You earn money, you pay tax, and then you spend. You earn money, they withhold, and then you spend the leftovers. If you're a richie rich, if you're a business, you earn, spend, and then pay tax on the leftovers. You earn, spend, then tax. If you're a business, expenses reduce your income before you're taxed. Earn, spend on all these things called, necessary business expenses, ordinary, reasonable, necessary, customary, ordinary, reasonable, necessary. You're spending that money on things for that business, and then you pay tax. You work at McDonald's, you earn money, you pay tax, and then you spend the leftovers. A business owner doesn't pay tax on every dollar that comes in. They pay tax on what is left over. After legitimate business expenses, the car that you need for the business, the trip that you need to take for your business, your home office, your equipment, your computers, your cell phone, all of it, if it has a genuine business purpose, it reduces the income that you're taxed on. The government is effectively sharing the cost of running your business with you. A W-2 employee has almost none of this. They earn $1, they're taxed on $1. Number two, depreciation. It lets you take losses on paper while building your wealth. When a business owner buys a piece of equipment or a real estate investor buys a piece of real estate, the tax code allows them to deduct the cost of that asset that they bought over time, over its useful life. But sometimes you get to use something called bonus depreciation that allows you to take it all at once. So you might own a property that's going up in value every year. Simultaneously, you're showing a loss on your tax return. And that loss can shelter other income from tax as well. What's better is you don't even have to spend cash to get this benefit. I'm serious. You could quite literally buy a $3,000 computer on credit. Maybe you bought it on a credit card. And you write off 100% of that piece of equipment, saving yourself over $1,000 in taxes without spending a dime of cash. That's how the rich people do it. Right? They go out, they didn't come out of pocket. They spent $3,000. Maybe they're paying it over a period of time, but they get that immediate deduction of $3,000, which if you're in the 37% tax bracket is worth well over $1,000 in your pocket. But W-2 workers don't depreciate anything. They pay tax on the first dollar and the last dollar. Third, not all income is taxed the same. This is one that surprises people the most. If you earn $1 million as a salary, you are paying 37% federal tax on the top portion, plus state, plus payroll taxes. If you earn $1 million by selling an asset you've held for more than a year, like stock, a piece of real estate, a business, you're paying max at 20%. That's the federal capital gains rate. And there is something called a net investment income tax. That's a 3.8 surcharge when you get over a certain amount. But it's really, I'm going to say 20%, but for those of you who are accountants, you might be going, well, it's 23.8%. It's not 37%. And it's not subject to employment taxes. It is capped, and it is significantly less than the others. But there's ways around even paying those types of taxes. For example, with real estate, so long as you reinvest the money from the sale, I buy a property, it goes up in value, and I sell it, as long as you reinvest the money from the sale, say you sold it for $1 million, You bought another property for $1 million, you pay 0 taxes. Same $1 million, one person making his wages pays hundreds of thousands of dollars. Somebody else, maybe they're doing capital gains and they don't have a 1031 exchange or something like that, they pay about half of that. And then somebody else who knows some of the rules, maybe it's 1202, maybe it's 1031 exchanges, maybe it's a different type of exchange, a 721, something else, and they pay 0. Fourth, borrowed money isn't income. This is the 0%, right there. When you borrow against an asset, so let's say you own a portfolio of stocks or real estate, or with a lot of people it's their home. Maybe it's your cash value insurance policy, and you take a loan against it, that borrowed money is taxed at 0%. It is not taxable. You didn't earn it, you borrowed it. So wealthy people can access the value of their assets, live on that cash, and pay 0 tax on it, while their underlying assets continue to grow. It's called the buy, borrow, die strategy. It's not illegal. It is how the code is written. Fifth, real estate gets its own special rules. I already let the cat out of the bag when I mentioned about buying real estate in new real estate after you sell to avoid taxes. You see, 1031 exchanges in real estate allow you to sell a piece of investment real estate and roll every dollar of gain into a new property, tax deferred. And you could do this over and over again, repeatedly, potentially for your entire life, and never pay any capital gains on the appreciation. You can still borrow against it. When the property passes to your heirs after you've passed, the tax basis resets at its fair market value. But in English, you have decades of gain gone. You don't have to pay any tax. Nobody pays tax on it. So let's say somebody buys a rental years and years ago for $200,000. Years later, they sell it for $500,000, and they use that $500,000 to buy a $1 million apartment. They do a 1031 exchange, and they use that $500,000 to buy an even bigger property. We're playing Monopoly here, right? You're trading in your greenhouses for your red hotels. Let's say that you borrow $300,000 against that equity just to go spend. 10 years later, that apartment building, you sell it for $2 million, and you invest in a strip mall and a bunch of rental properties. You 1031 exchange it. And then you borrow another $1 million out. You've got $1.3 million in your pocket, you've got your real estate's growing, and then you pass away 20 years later, and that portfolio has grown over that period of time. Like we've had that properties now, they've been growing for years and years and years and years. It's grown to $10 million. And you think, well, now they're going to have to pay tax. Nope, 0 tax if the kids sell the properties. They inherit it, they sell it, its fair market value is stepped up, they pay no tax, nada, zilch, a big 0. You get a job, you pay taxes your entire life. You buy real estate, you pay nothing. Rules are rules. Congress, what are they telling you? They must want you to invest in real estate because, man, they sure incentivize it. 6, business owners get a deduction, W-2 workers simply don't. Under Section 1099A, 199A of the tax code, qualified business owners, you get to deduct 20% of your business income before it's taxed. I'm not misstating that. You make $100,000 as a sole proprietor, partnership, S Corp, boom, it's $80,000 because you get a 20% deduction. A W-2 employee gets nothing equivalent. It doesn't exist for them. Could you imagine if Uncle Sam just said, hey, ignore taxes on 20% of your salary? That would be pretty nice. Now, before I go any further, I want to be direct about something because I know that what some of you guys are thinking. It sounds like a rich gaming the system thing, right? Everybody else is stuck in this system, but the rich are gaming it. Well, here's the truth. These aren't loopholes. A loophole implies something unintended, like a mistake in the law that clever people exploit. That's not what this is. Every single thing I just described was written into the tax code intentionally by Congress, because Congress wants Americans to start businesses, to develop real estate, to invest capital, to create jobs. So they wrote incentives, real, permanent, substantial incentives for people who do those things. Using those incentives isn't cheating. It's doing exactly what Congress has asked for. There's an important legal distinction here too. Tax evasion, that's illegal. It's hiding income, falsifying records, lying to the IRS. That's criminal. Tax avoidance, arranging your affairs within the law to minimize what you owe, that's not only legal, it's something the courts have repeatedly upheld as a right. It is your right to pay the least amount of tax that you owe. You get to choose. The map exists. Using it isn't fraud, it's just navigation. So if all of this is legal, if the second road is open to everyone, why don't more people take it? Well, personally, I think it's an information gap, not an income gap. It's not a class barrier, it's an information gap. And frankly, it's available to everybody. Wealthy people have their CPAs, their tax attorneys, they have their financial advisors. Their entire job is providing, here's the toll-free area, here's the tax-free route. It's no different than driving to Disney World. The wealthy just get handed a different map because they know enough to use the laws the way they are written. That map leads to a different set of outcomes legally, deliberately, by design. The McDonald's worker I described earlier, that was me. Nobody sat down with me and said, here's what happens to your dollar before you even see it. And here's how to change that picture over time. Nobody handed me the map. Nobody hands that person the map. So they stay out on the toll road, not by choice, but really by default. And here's what I want you to take from that. It's not the system. It's not like it's hopelessly stacked against workers. To the contrary, a massive number of regular people become millionaires using a handful of simple tax strategies like 401ks, IRAs, HSAs, using real estate, using the short-term rental loophole, real estate professional status, stocks for capital gains. There's nothing fancy. It's that the system rewards people who understand it, and understanding it is available to anyone willing to seek it out. And you're doing that right now, by the way. The playing field is more level than most people believe if you know the rules. So here's what I want to leave you. There are two roads to Disney World. One has tolls, one doesn't. They both get you there. The difference isn't which road is legal. They're both legal. The difference is whether you know the second one even exists. The U.S. tax code has two systems. One applies to you automatically. That's the default, McDonald's. The other one you have to choose to use, and that's a choice, the real choice. And it starts with you deciding that you want a different map. If you want to understand what that looks like for your specific situation, for your income, your assets, your structure, that's exactly what we do at Anderson Advisors. In fact, I'll put a link if you want to talk to somebody in the description. Absolutely free. Come talk to us, see if there's anything that you could do. Are there any moves so you can keep more money in your pocket? And if this video handed you something useful, piece of the map that you didn't know before, subscribe, please, to this channel, because that's what this channel is for. Not to complain about the tax code. That doesn't help you navigate it. So subscribe and join me, and I promise you, you'll learn things that help you keep more of your money. Seriously, subscribe and plug in for a few weeks and take an honest assessment of what you've learned. You'll be surprised at how much you learn in a short period of time. Good luck to you.